Well, Powell didn't want the bullish Wall Street reaction, but he knows that policy works with a lag of about 6 months. So whatever they do in September is going to show up in first quarter, March of 2023. They're aware of that. And as a consequence, I think by then you'll have much lower inflation, much. And I think that the Fed will be more in a position to turn more dovish. The market hopefully anticipates that in advance. So I wouldn't overreact to what we saw today. I looked at all the measures before I came in here. Financial conditions are only back to where they were on a 5-year average prior to COVID. PE ratios have gotten more reasonable. So I really don't expect the new low crowd to win out on this one.
So nothing significantly changed today? I mean, do you feel like the stock market was just a little off sides with Powell? The bond market in recent days sort of moved more into alignment where perhaps they thought the Fed was going to be. Maybe it just took the stock market an extra day to get there?
I think, if you think about the market, it tends to move directionally right, but then gets ahead of itself or overshoots on the downside. I think it may have gotten a little ahead of itself in the very near term, but 6 months from now, and that's when the policy will really take effect, we're going to have dramatically lower inflation. Energy, food, goods, even services, shelter, rent. They've all either rolled over or all of their leading indicators have rolled over. I would worry a lot less about that. We didn't, as you said before on the show, have that much of a bond market reaction today. So it didn't lead me to believe that valuations will go under a lot of pressure. Earnings are still good. Consumers are still sitting on $2 trillion of extra cash. The top 75% of all consumers distribute that cash fairly well. It's not all concentrated. So the situation's really not that bad. Every leading indicator indicates there's no traditional recession until June of 2023.
So I would take issue with this. What if, as you say, 6 months from now, you expect inflation to be a lot lower than it is now? And we obviously all hope you are correct. The problem with that is, OK, great. So it goes from 9% to 5%. That's not 2%. And then they still have a lot more work to do to get it to 2%. Are we taking that fully into account and appreciating that as much as we need to?
Everything I model out says that the core PCE will hit the Fed's 2.7 target in the last SEP by middle of 23, and CPI headline will be just barely above 3. So that's pretty good.
S&P end of this year is what? What's your current target?
I've been doing this a long time, and fighting seasonality is not a very good profession. The market is weaker May to October and very strong November to April. When you go against that 2 out of 3 times, you lose. And that's worked for 72 years straight, if you take an average. So what I'm saying is we will be 4,400 by year end. We could have some of that backloaded in the fourth quarter, but I'm still bullish, and I like growth. Weakening inflation and a little better than expected economy, in other words, no recession, that pushes you into software, media, entertainment, technology, hardware, retail, and semiconductors, which is big tech.